The late night DJ audio voice.
Yeah.
Coming to you live. We got movie tickets
Hey,
coming
everybody,
up
coming
next.
to you live. It's Wealth Wisdom, and today we're helping you build and preserve your legacy. Welcome, everybody, to another week of Wealth Wisdom, where we're helping you build wealth and legacy.
Companies are like an organism trying to survive.
It's always a risk when you're investing in a company that's purely tied to someone's brand.
45% of Americans have gone into debt for a Disney trip. All right. Welcome to another episode of Wealth Wisdom. I'm Justin Opie. I'm here with my esteemed colleagues, Eric Benz and Bill Ryan. And today we're diving into a topic that's probably you've all heard and probably on your mind a lot, is this whole misconception of how risky is the stock market. And a lot of people are afraid to invest in stocks. It's something we hear a lot with new clients who are potentially considering joining up with us, but it's so risky. And so we wanted to dive into this topic for you today and really debunk that myth and explain why here at Foxhill Wealth Management, we're so bullish on the long-term view of the stock market. And so dive in, Bill. A lot of people, the other day, I think you were talking to someone, you jumped off the phone, you came into my office and you were like, everyone thinks it's so risky. And that's what the inspiration of the podcast today was. What do you think, what drives that emotional feeling for folks?
It's a combination of the media, obviously, when things are going bad, right? It's front page news every time. And that's probably the leading driver of that fear and things along those lines. I think when that happens, that causes people to look at maybe their investment, whether it be their 401k or their brokerage or something along those lines, right? And then that's probably the biggest driver of those fears and things like that. And maybe not a lot of times, right? Not having a steady hand that they can talk to get them through those volatile times. Because a lot of times, if you don't have someone who's able to take the emotion out of things, look at the big picture, look at the scope of how things are working in the economy, then you get inside your own head a little bit, right? And you think, oh, what if this is never going to come back? What if this is going to, things along those types of ideas creep into your brain. And that's why it's great to have a steward to lead you through those turbulent market times to get you back up to where you were and get you making money again. And inevitably, when you look at the amazing technologies and things that are coming out on a daily basis and what we have ahead, there should be a lot of good times ahead in the market.
Oh, for sure.
That doesn't mean in the short term we're going to go through the market is very inefficient in the short term. Things go up and down for sometimes no reason, right? The long-term outlook of the company, you say, hey, by 2030, this company is going to whatever in size, right? But their stock still goes down. Sometimes in the meantime, it's not a straight trajectory up. So during those times, you have to take a step back, evaluate where things are, and when you will do really well, right? Over those times, it's just that you have to keep a steady hand during
totally. We were doing research before this to really drive value for everyone listening. The minor pullbacks, Eric, they're common throughout the year, right? They always occur multiple times a year throughout, and then corrections every 1 to 2 years. Eric, what do you think about that in your role as a financial advisor for your clients? Just knowing that.
Knowing that those happen often, that's our job. Clients don't always remember that. They think when a correction, which is a 10 to 19% decline, happens about 1 every 2 years, oftentimes clients think, oh, this is the next 2008. This is the next 2001 .com boom. We're in the middle of an AI boom. Is this the next 2001? There's always that kind of mindset coming from clients. A lot of media hype. But Bill was saying our job is to coach clients through that, give them reminders that, hey, the American economy is strong right now. Hey, all these companies are coming out with really creative ideas. They're increasing efficiency. Might be volatility in the short term, but in the long term, we fully believe that these companies will be up and your portfolio would be better for it by having stayed invested and staying invested in the stock market itself.
So really, just listening to both of you guys to summarize what I'm hearing is really overall, we're not afraid that the U.S. market is going to continue to go up over time because of tech, because of all the great things that innovation, great things that the people in this country are doing. But I'm feeling like there's also like there's a lot of mindset to this, and what we're helping people do is coach them through those emotional times. Because I feel like the emotions of investing, like for some reason, Bill, like everyone naturally will try to sell at the exact wrong time and buy at the exactly wrong time. Do you know what I'm talking about?
It goes against all the psychological being like that we are, right? You know what I mean? That a successful investor, literally, you have to go against everything that you want to do, right? When things are at their worst and it's like, oh God, it's gonna get worse. It's gonna get worse. That's really the time, right? You need to be greedy, right? So be greedy when others are fearful, right? You know what I mean? And then that euphoria when you open up your account statement and you see how well it's doing, right? You're like, I got to get more money in, right? You know what I mean? I got to get more money. I'm losing out. I get, right? The fear of missing out, that's what people feel, right? They want to get in. And there's studies that show over and over again the inflows of money into the market during the really good time, outflows right at the absolute worst times. And those really, I don't think it's so bad during the good times to put money in, because I think if you still have a long term, even if you do catch the wave at the wrong time, you'll still be fine long term. But really, what's really detrimental to someone's wealth in their portfolio is pulling out
Oh, for
at the
sure.
worst times,
Yep.
right? That's really where that's going to hurt you much, much more than any correction is pulling out at the wrong times. That's where you're going to have a really detrimental effect on your long-term wealth. And that's what we try to get people to really think about and take a hard look at before, you know what I mean, before doing anything like that, because that's really selling at the bottom. That locks you in, right? That locks that
Yeah.
loss in. And if you do that, then you're not able to ride the recovery, which many times is very quick. There's no, hey, we'll get back in when things are starting to do better. You're going to, right? Because the market moves much more in advance. It's much more forward thinking than humans. Those peaks of light in the morning start coming in real quick. It goes from real dark at night to light real. If you've ever seen it or ever seen the sunset, I
Sunrise.
mean, not that's similar to the market. Those things come in quick, and next thing you might have missed a 10%
Sure.
tick up, a 15%, you know what I mean, tick up that happens very quickly. We want to make sure that our clients are there for when that recovery happens, that they are realizing every single aspect of the recovery, right? And that's how they're able
Yep.
to recover, get back up to where they were, get you in a pause, you know what I mean, get your account back in positive and making money again. It's so important.
Yeah, we've seen clients in 2020. There were certainly clients that called in wanting to get out and try to tell them, no, stay invested. Market rallied in a span of 3 months during COVID. A lot of times it's the usual suspects, but you'll have clients call in during election season thinking, depending on who wins, that it's going to make a massive difference in the market. A lot of them saying, hey, I'll get out now, I'll get back in once the election's over. A lot of times, though, the market rally might happen a day or two right after the election, and by then you've already missed out on a significant gain. Definitely a lot of things like that. I don't know, Bill, if you see clients wanting to get out of the market for other reasons or other events that have happened in the past. Once again, it's staying invested. The saying in the industry is time in the market, time spent invested versus timing the market. Impossible to do.
Yeah, certainly. There's a multitude of factors, right? And you name it, it could be election, a pandemic. Something's going to come up, right? Every week, I feel like there's something, right, that comes in. Inflation numbers didn't come in the way we wanted. Jobs report didn't
global
come in.
conflicts.
There's, exactly, right. Some type of spat happened somewhere, or I shouldn't say little, but there's a spat happened somewhere in the world, right, where there's, again, that it creates an uncertainty in the market. That uncertainty breeds issues, and when that happens, the market reacts immediately, right? You know what I mean? Things like that, and usually it doesn't react accordingly.
Yeah.
It overreacts, right? That's the one thing about the stock market. It typically overreacts, at least again in the short term, right? And then as we gain more information, and as things tend to, you know what I mean, to unfold, we see that recovery happen, and then going forward, we tend to see that growth.
Yeah. So can you time? A lot of people try to time the market. So what are your thoughts on trying to time the market? Possible?
That's the
one
way to
lose.
lose.
Really? Okay.
Right.
Yeah.
I mean, it's very. If you're going to try to play that game, I'm going to say that, not that it's a sure loser, it's just that it is so incredibly tough. Why you want to do something? You're going to do something where if you were playing baseball, right? And are you going to put someone in who gets a hit 2% of the time? No, you want to put that person who's a 300, right? Something like that. And you want to increase your statistical odds. And time again, they show how incredibly difficult it is to time the market in the short term. Again, so when you look at over the long term, your odds are extremely good, right? You know what I mean? But when you look over the short term of trying to time the market, so incredibly difficult. And again, the market is so forward thinking. It's not that it reacts before it's humanly possible to, before your emotions are comfortable. That's, you know what I mean? That at that point, you've already missed huge gains. And I know we have some statistics.
Yeah, I was just going to ask that, Eric. Do you know the statistics
show
for if you stay fully invested and you've got the balls to stay in during the down times because you've got a great advisor coaching you through, versus if you bail at the exact wrong times? Are there any stats around that we can share?
Yeah. So 1993 to 2023, if you had stayed fully invested in the S&P 500 during a 30-year period, average annualized return is 10.3%. If you miss those 10 best days in the market, your annualized return would be dropped to about 5.9% versus that 10.3 we're talking about. If you miss the 20 best days, your return would plummet to 3.6% a year.
So it's 10%
just 20 days, right?
return, which is really, if you consider inflation, but an average of 2 to 3% on average. I know the past 4 years are anomaly, but
in your portfolio as a total, right? It would literally be cut in
completely
half during that time. And then if you miss the 20 best days, cuts into a third, right, of what you have. I mean, at 10%, right, 10 plus percent over a 30-year period, that is doubling, right, 4 times. You know what I mean? You put in $10,000, that's going to go from 20 to 40 to 80 to 160 on a $10,000 investment, right? If you miss those 10 days, you're now going from 10,000 to 80. It's that devastating, right?
And that's if you just throw your money in the standard general market.
Yeah. Yep. 500 of the biggest.
And that's like a passive investment approach.
500 large.
And for my just working with you guys so long, you guys take a very active approach to how we invest. Can we dive into that? I know there's more stats we can share, and we'll share that throughout the episode. But let's just why don't Eric? Why are you guys so against just throwing client money into ETFs and mutual funds? Or do you? Maybe I'm wrong. Do you ever pick managers versus stocks, or what's the investment philosophy? And I guess why? And both of you guys chime in. I'd love to hear that.
Right. What makes us different than other investment advisors is most of them are not necessarily actively managing your money. They're buying ETFs, they're buying mutual funds, they're using other managers, they're buying big baskets that represent the whole US economy. The way we tend to manage is actually buying individual stocks and diversifying over different sectors. And we're actually using investment research in order to pick those individual stocks. We're not geniuses. We have a committee and a process in place to look at those different companies. What we're trying to achieve with one of our models, journey or growth, if you want to call it, is all about trying to obtain alpha over, let's say, the S&P 500. We're trying to beat that performance.
So that 10% S&P.
We're diversified over different sectors.
Got it. Okay.
Yeah, exactly. Yeah, we're trying to beat that for our clients. And then we have another strategy, which we call stability. That's our alternative to fixed income. In that strategy, we're buying utility companies. Those give clients a dividend yield and price appreciation, so their portfolio will grow over time as well. And we believe that better sets them up for greater portfolio return.
Yeah.
Depending on what the client's financial plan is, we'll allocate often between those two different strategies. We're not necessarily trying to manage to risk tolerance. We'll do risk tolerance reports for clients to try to gauge what they're comfortable with, but most often we're really trying to manage to a financial plan for our clients. We know, hey, you need this number, you want to spend this amount of money in retirement, you're going to buy a house at this time, things along those lines. Let's get you to that number. Let's invest in a way that's going to get you there. A lot of times we see risk tolerance as a construct kind of created by the financial industry to scare people a little bit. We're trying to manage to a financial plan, not to tolerance necessarily.
No, I guess that makes sense.
Ahead.
Just
I
never thought about it like that. But if my goal was to retire with $10 million, but my risk tolerance is super low, and I want you to just invest very conservatively, it's probably not possible to do that if I'm starting at, I don't know, $1 million or something, or whatever, if I'm starting very low.
You better have a lot of cash flow to be funding that investment. You know what I mean? If you're not willing. So if you're contributing a lot of money, it's very possible, right? But it's not going to be due to capital appreciation within your account, certainly. You know what I mean?
Yeah. So you guys are actually just pushing, and when risk profile is just my comfort level of risk, but it sounds like how risky is your method, Bill? It doesn't sound like it's risky at all.
It's not that it's risky in terms of you know what I mean, lose all your money by any means or anything like that. We're investing in companies that have massive market caps and are very ingrained in society. We also have aspect to our strategy that that would prevent, right? If something really were to happen, say for example an Enron, or many times over, the analysts that we follow basically revise the earning estimates of these companies down several times. And what we do is we sell once we've had one downwards earning estimate revision, right? So that's going to prevent from those catastrophic losses, right? And that's how we deal with that risk, where people say, oh God, am I going to lose all my money? I hear that, and I say that's one thing that I can guarantee. We would never lose all your money, you know what I mean, or anything like that. That's and I don't make any guarantees. That's the one guarantee I will make. If we did, we'd all be in a lot more trouble. We wouldn't even be able to record this podcast. Let's just put it that way. That's how Mad Max of the situation. But so that's just like Eric was saying, though, I'm much more, I feel that with going to the financial plan, going and flows around that, right? We set up the investment strategy for each client individually to manage to what they need, right? So where their cash flows, their things that they need in the coming years, very well protected. That money is not going to necessarily be invested in the stock market. We're going to use certain bond instruments or cash instruments that are very liquid and to them, right? And so that money is assured to be there when they need to pay their mortgage, their vacation that year, anything. Those things are planned for in the coming years. And then that money that's dedicated for further out, we want to make sure that's appreciating in value, keeping up with inflation, beating inflation, you know what I mean, and having growth. And that's why we feel so strongly in the market, is that while there is volatility in the market, that is the price we pay, right, for investing in something that is not only going to keep up with inflation, beat inflation, right? So we know that over time it's going to grow, but the price we do pay is that volatility, right, which can be a little daunting, especially in those dark moments.
Right. But you guys are coaching, you're helping people through those moments emotionally. And then you have the investment committee. I know that, Eric, you had mentioned. How is the investment committee structured? How does that work? Or if you let us know. I don't know if you can talk about that.
No, here, I'll run through it quick. Actually, we should probably start, but before we even get to the investment committee part, the way we select the companies we put into our strategies is very process oriented. we use JP Morgan research to then narrow down a giant stock list. There's thousands of different stocks we can invest in. We use JP Morgan analyst earnings estimate revisions. We want to make sure companies have multiple estimate revisions upwards in a row. From that, we like 2 in a row. From that, we'll narrow it down. There might be like 300 available stocks to buy. So that we have a narrowed list. We then go to our investment committee. Each of us might bring in a few different ideas of companies we're looking at. From there, we'll discuss, narrow it down. And then within that, we'll then add maybe 1 or 2 companies onto the list. We're also looking at things like, which company is coming out that's a sell? Maybe we want to replace it with a company that's also in that similar kind of sector. A lot of times we're trying to make sure we're diversified. For instance, right now within our growth strategy or journey, depending what you want to call it, we have industrials, we have consumer discretionary stocks, consumer staples, healthcare, financials, information technology, and a few multi-sector companies as well. What this helps us do is a lot of times when one sector might be down, another might be up. So that's that diversification we're talking about. Process-wise too, as a committee, it's not necessarily that formal, but we're all so opinionated. We tend to have devil's advocates every time we're looking at a different company. Ultimately, our goal is outperform the market, but a lot of times we also want to make sure we're not investing in something that's too risky for clients or something that we think is simply a high flyer and there's no merit to why it's priced at a certain point. So we're digging into the research. We all have a lot of opinions, but there is a process there. Bill, I'm sure I missed stuff. Is there something you could add to that?
No, I think you did a really good job of that. Yeah, we have that. Like we said, we bring up that data. We utilize that data for why we buy something, and not only do we from the data, but then also we're looking at industry trends, big picture things. Okay, why? Yeah, macro ideas. Why do we think that we're going to be a little more focused in a certain area than another? We keep diversified as a whole, right? That's one thing I hear people say is, we're only in this one account or something like that. But you got to remember, each stock has its own risk profile, right?
Yeah,
so we're diversified among, for example, just in that growth, right, 15 to 20 stocks, which some people say, that's not that many, right? But most of the great investors and the people who have done extremely well, they'll actually argue you really don't need much more than 8 stocks if you're very
like
high,
Buffett.
high conviction on them. Or, yeah, you know what I mean? They're obviously a massive conglomerate and actually a holding, right, for us right now. But but a lot of the again, the great investors, they typically have a concentrated portfolio, right? We achieve diversification through those stocks, but we do have a concentrated portfolio. And the hopes of that is that those stocks that we pick, we have some that very much outperform the market, right? So they're, those holdings that go up 100%, 200%, 300% through that concentration allows us to outperform the market as a whole.
Yeah, so that's really interesting. How I know that probably every disclaimer I've ever read says past performance is not an indicator of future performance. But what has been the historic performance for your portfolios not year to date, but can you share any of that or?
Yeah, I have those data points, Justin. The one thing to keep in mind is when we go into client meetings, I actually rarely even pull up. The thing that's most important is investing to one's financial plan and investing with a strategy in mind. Then the performance follows. That being said, what we've done since 12/31/2022, so we're talking about a span of, I don't know, a little bit over and a half. We've returned about 47.6% in our growth strategy. A lot of that has actually happened over a span of 12 months as we've seen this tech rally. So over the 12 months for our growth stuff, we call it the journey strategy, 46.7%. And that's an entirely stock portfolio.
That's phenomenal.
Our stability strategy, which has the utility companies, and that's our to fixed income. That's returned 29.6% over that kind of year and a half period, 12/31/2022 to 10/9/2024. Over the last 12 months, it's seen crazy growth. 47.7% is what it's up. And a lot of that is the same thing. It's this amount of energy that's going to be required to power all these data centers is being projected out, and the utility companies have rallied significantly from there. That being said, the 2 years prior, the utilities companies were all down. They significantly underperformed the rest of the market. In 2022, they were actually down, I think, about 20% overall. Having a long-term outlook is the most important thing. Investing to a strategy, staying invested, all the things that we've been hammering home there.
Yeah, that really illustrates it clearly.
Yeah.
Having that long-term approach, right? Because if you looked at the utilities in 23 and just watching as interest rates went up and commodities were costing so much, it was a difficult year, right? You look at the rest of the market, you say, hey, geez, the rest of the market's going up, but utilities are the worst performing sector. But again, we're not looking at it over a year or two years. We're looking at what we think is going to happen over the long term, that 3+ years. And with that, right now we're seeing everything that's been going on as the rate increases have happened, the rate increases which they charge, right? Residential and commercial customers, as the expansion, right, of these companies as rates themselves, right? These companies have so debt is a big thing for utility companies, right? Because they're obviously the equipment and the layout and everything that goes into running a utility. It's big dollars, right, that are being spent. So they have large debt balances, and they can be very affected by interest rates, especially big changes in interest rates, right, that can hit price. So when we saw interest rates rising at a historically fast pace, understandably, that affected utility companies, right? And you couple that with the fact that if someone sees 5.5% in a short-term treasury, and they say, these dividends and this is only paying, we'll say 4.25, right? You know what I mean? On average, they say, I can get 5.5 with no volatility.
Sure.
Or I can get 4.25 with volatility. Geez, I think I'm gonna shade right towards that. So there was a big pull out of that of utilities as an investment, right? Eventually, it became more attractive. Those valuations. Then we saw that recovery tend to take shape. But what's nice is when you stay invested, right, and you're using those dividends to maybe potentially buy more shares, right? You're buying at a depressed level. And then as that recovery happens, right, you get to see that capital within the stock. And those investors have been rewarded. You know what I mean? It's this year for staying, whereas like they would outperform bonds, right? You know what I mean? Over the long term. And that's what we're trying to do, because bonds will pay that coupon, right? But you don't get any capital appreciation, right? Whereas the utilities and other dividend paying stocks pay that dividend, and where we're looking for something that's going to raise the dividend in the next 12 months. So as that goes up as well, we're not only getting that quote unquote coupon payment or dividend payment, we're now getting capital
on top
appreciation
of
within the underlying stock price. And that's what helps not only keep up with inflation, but beat inflation and have growth within their portfolio from a real rate of return.
That makes sense. And just again, it sounds like just riding those little bumps, those speed bumps in the road, just stay on the road. And if you had bailed on that time when utility were down, wouldn't have made sense. Kind of bringing it full circle, really. And I think if you had just like the biggest downturn of my lifetime, maybe or not, but I think it was 2008. Everyone was like deathly afraid of investing. I mean, it was a true bloodbath. I think there's a data point on that, but basically after every downturn, there's a massive upturn in money flooding back in. To make your point earlier in the show, Bill, like the sunrise comes early and comes fast. Do you know that data point for 2008?
Yeah,
You're a data
S&P
guy.
500 hit its low in March 2009. This is after 2008, right? Financial crisis. Then returned approximately 68% over the next 12 months. Yeah.
Oh, just in 12 months.
Rally. And the people that sell at the bottom there,
correct.
Oh my gosh. And then miss the opportunity to build generational wealth when you do stuff.
So what's like the number one takeaway you guys want people to, as we wrap up the show, like what's the number one for each of you that you want listeners taking away from today's show? Eric?
I want people to know that the way we invest is a little bit unique. It's not like everybody else. We buy individual companies, and people don't need to be scared away when they hear that. And the reason being is there is such a thing as over diversification. When you're buying the S&P 500, you're buying all 500 companies. Guess what? There's a lot of bad performers in the S&P 500. Year to date, Walgreens is down 65%. Dexcom's down 43%. Boeing is down 44%.
Wow.
That's just year to date. So when you're buying it, you're buying that whole basket of companies. If you buy a concentrated portfolio, 15 to 20 stocks, that's diversified over some different sectors, not over diversified, you really have an opportunity to outperform the overall market because you're not, owning some of those laggards.
Wow. That's serious data. Yeah, that's crazy. That's why it's only 10%, right?
And yeah, exactly. And the last data point is when you buy the S&P 500, you're buying 500 companies, but it's weighted based on market cap. As of 2024, the Magnificent Seven actually make up 30% of the S&P 500's overall weight. So when you are buying it, those are a lot of times primarily the companies you're invested in. You might even be less diversified than you actually realize. You're really owning 30% of your portfolio ends up being Microsoft, Apple, NVIDIA, Google, Amazon, Facebook, and Tesla.
Wow. That's crazy. And then what about mutual funds? I know you're talking ETFs and to get into the S&P possibly, or like a Vanguard index fund or something. What about if you pick mutual funds, if anyone's interested in that listening? Why? I know this is a last minute question out of left field here, but I was just curious as listening to you. How come you don't pick mutual funds? Are they a good bet? Or because I believe I saw, do they outperform the market ever or no?
I mean, there are certainly some that do, but essentially what a mutual fund is, it's made up of, if it's a stock mutual fund, it's just made up of a basket of stocks. And in terms of our stocks and bonds and things like that, we're basically in order to get diversification, we're doing that in that sense. Yeah. That's similar. I think I'm not sure what the statistics are, but I want to say 80 to 90% of mutual funds do underperform their benchmark over a 10-year period, right?
Yeah.
So underperform, underperform. And our goal is to be that with a percentage that outperform.
And they're charging pretty big fees too.
So
as a mutual fund, most of them are charging fees on top of their underperformance. So I guess that's the answer right there.
Well, and it's hidden within the fund too. Yeah. You don't see those fees come out. That's the other thing. It's not very transparent. The way mutual funds take fees.
Sorry.
Typically, it is reported. Mutual funds do report net of fees. You know what I mean? Their performance net of fees. It's not if they report a number, then you're like, oh, and I'm paying fees on top of that. That's what their net is. But yeah.
So you guys are able to step over that completely by not going to mutual funds and do it yourself through your active managed portfolio. Really, with low fees.
We in a way make our own fund, and it's incredibly transparent. People can see the exact fees they're paying. That being said, we're not like, if you don't have an advisor, like owning an ETF or a mutual fund is a great way to build wealth. And we're not, the reason people like Warren Buffett are telling people to buy the S&P 500 is because a lot of times the alternative is that they don't want people gambling on penny stocks.
Yeah.
So that's why they're recommending that. And other thing too, Justin, is there's plenty of bad managers, bad financial advisors out there too. So you want to make sure you got a good one as well. So
And it's not even
the
penny
alternative
stocks. Those stocks that you just mentioned, Eric, a few minutes ago, those are by no
yeah,
means penny
Yeah.
stocks, right? These are
true.
massive corporations, right, that have had terrible performance. And there are companies that languish over
Yeah.
years and years and years with not
Oh,
very
yeah,
good
Intel.
performance, right? It doesn't take a lot and they can still stay in the
Wow.
S&P 500. Right, not do very well. Those are things, but that's why we're constantly looking at companies where the
Yeah.
future looks bright, right? You know what I mean? And trying to get you out of companies where maybe something's going on, and it could be anything, whether it be geopolitical risk or certain things with the market, certain things with interest rates. Everything is being
Yeah.
kept in mind, right, at all times. So we're constantly utilizing the information that is out there, and that is moving that is making are helping us make our investment decisions, right, on a constant basis. So we're constantly looking at everything that's going on in the world that can have an effect on the
Yeah.
stocks that we own. And that is what that information is what we're using for why we would buy something that is affecting why we would sell it. And then at that time, when we do sell, where are the stocks at that time that have a good
Right.
outlook? And then we're taking the proceeds of that sale and putting it into a company that at that time has a very good outlook. And that it's something that is
Yeah.
performed very
That's why I
well.
love our newsletter. It's all the thinking wrapped up into the macro and the micro throughout. So it's a great resource and just insight into how we're thinking. Bill, what's one takeaway that you want listeners to walk away from if hopefully they're still listening here, but if we still got you, Bill, why don't you drop something?
Yeah, no, I think the one takeaway is just making sure that you invest to your financial plan, right? You invest to your time of your cash flow needs. And for that money that's for the long term, you want to make sure that you're investing in equities and doing it in a manner so that you can take advantage of the long-term growth of the market and all the amazing technologies and things that are out there. It doesn't necessarily need to be in tech, right? Tech, I think, spreads across all businesses.
Yeah, certainly.
And some make the point that even, I don't know, a hardware store,
Yep.
right? You know what I mean? Like technology within it might make that a better user experience and people might buy more goods, right? You know what I mean? Due to the technology that they have involved. I know, for example, if I want to go into Lowe's or Home Depot, I like going on the app, seeing where the product is that I need, what row,
Sure.
where it is in there, and going grabbing it and making a purchase. But all the amazing technologies that are out there will help the economy, you know what I mean, and the market it grow. And there's so much out there and so much what I believe should be optimism for why the markets will continue to grow. And we're going to go through dark times. That is an inevitable. I think some of the stats that Eric was talking about earlier, and then also too, every 3 or 4 years, right, we have a 20% or more pullback, right? So that happens, and you look at your account, and whether it goes from 100 to 80 or a million to 800, or you know what I mean, or less, or 10 to 8, you know what I mean, something like that's devastating, right? At that time.
But it sounds like it's just seasonal,
but allowing
right? It
the
sounds like
market,
it's just winter, right? And then after winter comes spring.
that's true, but that lasts a long time. You know what I mean? And how many times have you said, right, in March, is this winter ever going to end? You know what I mean? So it does seem at those
That's
times
that
that
game of
winter is coming. It always is, but you get through it.
Right.
And just that during those times, it can be dark, but you have to stay invested and know that these companies are going to recover. They're going to do everything they can to increase profits, increase earnings, and then then their stock price hopefully will then get pulled along, right, by those earnings increases. And that's the thing, is that is a constant thing in good times, in bad times, right? They're always trying to do that, and staying invested in the equity market can be extremely financially rewarding.
Over
Again,
time. I love that. I love the optimism. I love the optimistic outlook, because it can, and I think that's where we should end it today, because the media will have you, if you listen to the media all the time, it'll have you believing negative everything. And there are so many great things happening in this world, a lot to be optimistic about. So I think it's a great way to end it right there. Thanks, guys. That's another amazing episode of Wealth Wisdom. Hope to see you guys again soon. Bye-bye.
Bye-bye.